This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but prefer it. But we only swing at pitches we like, and if anybody tried to swing at every pitch or felt that because they hadn't swung at a pitch for two.
And now here's the exciting part. In this video, we're discussing a curated list of 5 AI stocks primed to double in the coming year. What sets these picks apart is not just their potential for growth, but the undeniable proof that they've already delivered substantial gains. We recommended these stocks to our private Discord server members just a few weeks ago, and now these stocks have already surged by 30 to 40%. The anticipation builds as we project a doubling of these stocks in 2024 from the recommended buying level.
Before we proceed, here's a brief announcement. We've launched a free investment discussion community where we share 3 promising stocks daily. 2 weeks ago, one of our members purchased a recommended stock and saw a 50% increase in just 2 weeks. In addition to stock recommendations, we offer free investment advice from financial advisors to help optimize your investment strategy. Please consider joining our community.
Warren Buffett is universally regarded as the greatest investor of all time. However, he has been eerily quiet as of late when it comes to buying stocks. In fact, Buffett has even been selling billions of dollars worth of Apple stock. A company just a couple of years ago was considered one of his, quote, forever holdings. As a result, Buffett's cash pile at Berkshire Hathaway has hit a staggering $189 billion, leaving many people to believe he is piling up cash to prepare for an upcoming stock market crash. He surely does always seem to have a large amount of cash ready to buy stocks when the market crashes. In gray here, we have the Berkshire Hathaway cash pile by quarter from the years 1996 to 2018. The orange line represents the price of the S&P 500 during that time period. There's a couple of very important time periods to draw your attention to. The first is the dot-com bubble in 1998 and 1999. As you can see here, the S&P 500 was up over 50% from the beginning of 1998 to its eventual peak just a couple of years later. During that time, Warren Buffett was avoiding investing in the stock market. As you can see, Berkshire's cash position climbed by a factor of 10 over just a couple of years. How the stock market was in a serious bubble. In his wholesome and folksy way, Buffett told the crowd that while things may look great now, it was only a matter of time before the hypothetical music stopped playing. As I'm sure you can imagine, this did not make Buffett popular amongst the crowd. In fact, he was practically booed off stage. I'm sure you know how this story ends, however. Not too long after Buffett's speech, the dot-com bubble burst. The S&P fell by over 50% and the tech-heavy Nasdaq fell by a staggering 75%. In fact, it wasn't until the year 2015, 15 years later, when the Nasdaq returned to levels hit during the peak of the bubble. Many of the people that said Buffett was washed up saw their fortunes disappear in the crash. Going back to the chart of Buffett's cash position, Buffett used the dot-com bubble crash as a buying opportunity, spending down his cash position buying attractive investments for cheap prices. There is a saying that history doesn't repeat, but it sure does rhyme. You can see here that Buffett also built up a significant cash position during the run-up of the Great Financial Crisis. Buffett's cash pile grew to an all-time record at that time of over $40 billion, more than double the amount of cash Buffett had sitting on the sidelines during the dot-com bubble. As the stock market again sold off by over 50%, Buffett subsequently spent down his cash position, buying up wonderful assets for low prices. Buffett has nearly $200 billion in cash and cash equivalents, nearly 5 times the size of the amount of cash he had accumulated before the financial crisis. Given Buffett's track record of accumulating cash ahead of a major downturn, you can now understand why Buffett's actions are making people extremely nervous. There can only be one reason Buffett has allowed cash to pile up at Berkshire. Buffett can't find any attractive investments because the stock market is overvalued. In the year 2024, of course, Buffett will never come out and say that directly. He knows how much influence he has, and he doesn't want to be responsible for people going out and selling all their investments because he said the market was overvalued. However, let's rewind the clock to the year 2001, a year when Buffett was famous, but nowhere near what he is currently. As a result, Buffett was more willing to speak his mind freely. Listen to what he had to say back then when asked why cash was starting to pile up at Berkshire.
Well, there are times when we're awash in cash, and there have been plenty of times when we didn't have enough cash. Charlie and I remember in the late 60s, when bank credit was very difficult, we were looking for money over in the Middle East. You remember that, Charlie?
Yes, I do.
Yeah, and
They wanted us to repay it in dinars.
yeah, and the guy that wanted us to repay him in diners or dinars or whatever the hell they call them, was also the guy that determined the value of those things. So we were not terribly excited about him on payday and having him decide the exchange rate on that date. But we obviously are looking every day for ways to deploy cash, and we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it, just employ it. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se. In the mid 70s, we were scraping around for every dime we could find to buy things. We don't like lots of leverage, and we never will. We'll never borrow lots of money at Berkshire. It's just not our style. But you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it.
As we just heard from Buffett, he doesn't like holding large amounts of cash. He would rather be investing that money and using it to generate strong returns. However, Buffett also refuses to buy stocks unless prices are attractive. One way to measure whether the stock market is overvalued is to use the so-called Buffett indicator. The Buffett indicator was coined by, yep, you guessed it, Warren Buffett over 20 years ago. He has called it, quote, probably the best single measure of where stock valuations stand at any given moment. Once you see what the Buffett indicator is telling us about the stock market, you will understand why Buffett isn't buying stocks. The calculation for the Buffett indicator is a very simple fraction. On the top is the total value of the U.S. stock market as measured by the Wilshire 5000 index. This index seeks to capture 100% of the U.S. stock market and includes all U.S. listed stocks with readily available prices. As of March 31st of this year, the value of the stock market was $55.84 trillion. On the bottom of the fraction is the size of the U.S. economy as measured by gross domestic product, or GDP for short. GDP is the value of all the goods and services produced within a country and is used as a proxy for the size of an economy. The most recent GDP reading was $28.28 trillion. By dividing the value of the stock market, $55.84 trillion, by GDP, $28.28 trillion, we get a Buffett indicator of 197%. But the important question is, how does that compare to historical levels? Maybe 10% higher? What about 20%? If the stock market is really overvalued, maybe 30% higher than normal? Well, try again. The current Buffett indicator is a staggering 61% higher than the historical trend line shown here, a full 2 standard deviations above what is considered fairly valued. Put another way, this means that at the current size of the economy, the stock market would have to fall by a staggering 40% for it to be considered fairly valued. It now becomes awfully clear why Buffett has been selling stocks and building up cash. But what are everyday, individual investors supposed to do with this information?